Hi, I'm Mike Rambo with J&J Financial, and today I'm going to talk about the California Dream for All program and some of the updates that were made for this year's 2024 version. So to get right into it, the Dream for All program is a down payment assistance program where the state of California is giving buyers up to either 20% down towards their down payment and closing costs or $150,000, whichever is lesser. Now, this is an equity share program as opposed to having an interest rate on that amount of money that they're sharing or a grant program. So I'll be sure to get into that in a second here. So if you're not familiar with CalHFA has been around for a very long time. I personally have funded multiple loans through them, so just know that they are a state entity that are very much legitimate and do a lot of mortgage loans. So for this Dream for All program, some of the basic qualifications include that it must be used in a purchase transaction, meaning that you can't use this if you already own the home and you're trying to refinance the home. Also, anybody that's on the loan must be a first-time buyer. And in addition to that, everybody on the loan must also be living in the property that is being purchased. So you can't have mom and dad co-sign for you if they have their own home and they're just trying to help you qualify for the mortgage. Everybody on the loan must live in the home. A new requirement this year is that you have to be a first generation buyer, and I'll touch on that more in a moment. And then at least one person that's on the loan must also currently be a California resident. The funds are coming from California, so they want to make sure that the money's going to people living in California. In addition to that, there's some income limits I put just 4 that are in my local marketplace here, but the CalHFA website has a full breakdown of every county. And the income limits matter based on the home that you're going to buy, not the home that you live in. So if you live in Orange County, but you're buying in LA County, you follow the LA County income limit. All right, so a first generation buyer is being defined as somebody who has not owned a home in the last 7 years, right, which is different from just a typical first-time buyer is usually defined as somebody who hasn't owned it in the last 3 years. So they're expanding that to 7 years. And then it's based on the borrower's parents. So if your parents are currently living, then they're going to check to see and ask you if they currently own a home. If your parents are deceased, then it depends on whether or not they own the home at time of death. Now, there is one exception to this, and that's if you grew up in foster care, then you will qualify as a first-generation buyer and you don't have to meet the other requirements around whether or not your parents owned a home. You will have to sign a form when applying for the voucher for this loan that all information you're providing is true to the best of your knowledge under penalty of perjury, and CalHFA will be doing a third-party verification to make sure that what you're saying is true and that you truly are a first-generation borrower. So a couple of questions that have come up around scenarios with first generation. If you're estranged from your parents, unfortunately, that doesn't matter. If they own a home, you still would not be considered a first-generation buyer. If your parents are divorced, then it just depends on if either of them own a home. If one of them owns a home with their new spouse, then you are not considered a first-generation borrower. This one I thought was interesting. Someone in the training asked if you own investment properties, if you're considered a first-time buyer. And CalHFA responded that you will be considered a first-time buyer, but not a first-generation buyer. So imagine if you're purchasing with somebody else, and remember that just one person on the loan has to be a first-generation buyer. So say husband and wife are buying together, husband owns investment properties, wife doesn't have any ownership in those properties, and her parents have never owned a home, then those two potentially could qualify. And then just to reiterate that if you grew up in foster care, then you are eligible, and that is probably the largest exception that they're making. Before moving on too much, I just want to point out that the state of California thinks that home ownership is so critical to generational wealth that they've put that requirement in. And I think in 2024, there's a lot of talk of how the United States may become a renter's nation, and maybe that buying a home is a thing of the past and it just doesn't make financial sense anymore. This program to me is California saying they disagree. They're trying to bridge the generational wealth gap. And to do that, they're trying to help people get into homes that otherwise wouldn't have access from generational wealth. So I think that's a really valuable message from California. Now, if you fall within The base income limit for this, I put together a basic example. If you purchase the home at $500,000, then they will give you $100,000, which is 20%, that you may use for your down payment and closing costs. And let's just say that the home appreciates to $600,000, so just $100,000 in appreciation. You share 20% of the appreciation because that's how much you borrowed. So when this loan comes due, which I'll get into in a bit later, you owe CalHFA $120,000. The original $100,000 plus $20,000 from the share of appreciation. Now, if you fall into a lower income limit, which I can help you with, or a lender can help you determine, it's a smaller share in equity. They're only gonna, even though they'll still give you 20%, they're gonna only ask for 15% of your equity share. So in that same example, you owe back $115,000 rather than the $120,000 from the previous example. They are putting a cap on how much you can owe back, which would be 2.5% of the original loan amount. So once again, if you borrowed $100,000, then the max appreciation share that you can give back is $250,000. So in total, for that scenario, the max repayment to CalHFA would be $350,000. So I see this program being used in one of three ways, really similar to last year. First, probably most straightforward way is that you use that 20% down as your down payment. Now you have a loan that doesn't require mortgage insurance, and you pay for your closing costs either out of pocket, or you get the seller to help pay for it through credits, or you can have a gift from family to help pay for the closing costs. But nonetheless, CalHFA does the down payment, you and others figure out the closing costs. Strategy number two would be to use the funds for down payment and closing costs. So then rather than financing 80% with a lender like me, you're financing 85%. Now, typically when you're doing a 15% down payment, there's going to be mortgage insurance required on a conventional loan. So you can pay the monthly mortgage insurance, or you can look to do a single premium mortgage insurance where you pay it up front one time and just include that into your closing costs. And most of the time, that extra 5% that CalHFA has left over for you will be plenty of money to cover all closing costs plus that single premium MI. So what I'm saying is that a person can use the CalHFA loan to come in with truly no money out of pocket, and there's a way to structure it where they don't even have to pay monthly mortgage insurance either. And then the third way here is a person can use 5% of their own funds and pay for the closing costs, and then use the 20% from CalHFA on top of that. So this is a change from last year. Last year, CalHFA allowed a person to put 30% down plus the 20% from CalHFA. Once again, the program this year and the changes that they made are intentional to help get the money into the hands of the people who really need it. I think an argument is made that if you have 30% down already, you don't need this program. There's lots of other loan programs out there that you can use. So they're limiting the borrower contribution to only 5% down. So the advantage to that is that it lowers your monthly payment. And that's something that I see a lot right now with the current interest rate environment and price point where a lot of homes are right now, is that even if a person qualifies for a loan, they just have a really hard time budgeting that monthly payment. So this strategy is great to keep the monthly payment down. And in terms of qualifying, a person would actually qualify for a little bit more because it helps what we call your debt to income ratio. So a great way to utilize this loan. Now, this loan needs to be repaid when really one of four things happen. So if you sell the property, then you owe back the original loan balance plus your equity share. If you refinance, they will allow you to do what we call a rate and term refinance or a no cash out refinance just one time. So that's important because the common consensus is that mortgage rates will be coming down over the next year, 2 years, sometime in the very near future. So if a person uses this program, they can refinance, get a lower interest rate on their mortgage, and do that just one time without having to pay back the loan. If they want to refinance twice, then the CalHFA loan would come due for the original loan plus the equity share. If you don't sell and if you don't refinance twice, then it's just due in 30 years. I think the percentage of people that take this loan to 30 years is probably going to be pretty small, but nonetheless, that's there. And really the fourth option is pay off the CalHFA lien And if you pay the amount you borrowed down to zero, the equity share portion also comes due. And I put in there, don't do this, because the equity share does not change regardless of what the current balance is for that loan from CalHFA. So if you want to put money towards a loan and bring down your total loan balance on a property, don't put the money towards the CalHFA loan. Put the money towards your first mortgage, which does have an interest rate, so that you're saving money on the interest there. So while this is a scenario on how a CalHFA loan can come due or the Dream for All loan come due, it's not a good one. Okay, so how do you apply for this? The first thing you need to do is get pre-approved by a CalHFA approved lender. So that would be me or somebody like me. And then I recommend doing this sooner than later because sometimes it can take a little while to figure out a pre-approval. And even if it's really straightforward and your lender is able to approve you right away, then when the portal opens for you to submit your application to CalHFA in April, all the lender has to do is go back, maybe do a few minor adjustments and updates, and then get you a letter. And I do have a feeling that come April, when the portal opens, us lenders are going to get lots and lots of inquiries. So get ahead of the pack, get it done early. As I mentioned, in April, the portal is going to open. They said that they're going to open it, and April is a tentative date, but they're going to open it for 30 days. After 30 days, the portal for applications will close, and they say they're going to do a random assignment of vouchers. And the assignment is going to be done based on different area pods, essentially. So a certain number of people per area will be getting the funds. There's $250 million in funds that are going to be allocated. As I mentioned earlier, the max loan per person or per transaction is going to be $150,000. So if you do the math on that, then there's going to be probably just under 2,000 people who get this. And they're trying to spread it out across the state because in the first round of doing this, it was said that there was a heavy concentration in just one area that got these funds. So they're really trying to get it into the hands of people who need it and make it a little bit equal in terms of who gets it throughout the state. So they'll assign vouchers. If you're selected for a voucher, that voucher is good for 90 days. So that just means that you have 90 days to go out and get an offer accepted and open up escrow. Once you have opened up escrow, you'll have to complete your education courses, which I'll touch on in the next slide. And you just need to close that escrow within 60 days. Now, we understand that if you're buying new construction, sometimes the homes aren't ready yet. So in a case where you're buying a new construction home, they'll actually give you 120 days to close that transaction. Now, not everybody's going to use their voucher in 90 days. So CalHFA is keeping a wait list and will be reassigning vouchers as appropriate after the initial 90 days. As I mentioned, there's a lender training. So you don't need to do the training in order to get the voucher. So my recommendation would be do the Dream for All training right away so that you can understand what the equity share program is, how it works, and just whether or not it's for you or not. And then don't do the 8-hour course until you actually open up escrow on a property. There is a cost associated with it. So make sure that you're actually getting the home and buying a home before you spend the time and money to do that course. You just have to complete it before the end of escrow, which a typical escrow is 30 days. So you have plenty of time to complete the 8-hour course. So going back to some of the strategies that I talked about, you think about who's the right person for this loan, because this loan isn't going to be for everybody. So if you need money or cash to close, then this can be a great option for you. CalHFA hasn't released what the interest rates are going to be on this, but last year when I compared this to some type of minimum down payment loan, like an FHA loan, it was significant. It was maybe $700-800 a month difference in monthly payment. So if you're looking at doing just a standard down payment assistance or minimum down payment loan, this could potentially be a really good option for you. The other thing is that monthly payment. So once again, if it's $700 or $800 a month in payment, sometimes that's what the person needs to have it make sense for them to purchase the home. So that's a good person as well. And then if you just need to qualify for more, based on standard qualifications with conventional or FHA loans, if you just aren't qualified enough to get that house that suits where you are in your life and your needs, then this could be a good option. Once again, it's not for everybody. If you already have 20% down, if you even already have 10% down, and you're comfortable with where the monthly payments are, then traditional, conventional FHA loans, they have lower fees and lower interest rates typically than what we see on these CalHFA programs. So it's not that you have to do this program. But if you meet all the check boxes that we talked about, and then you fall into one of these three camps, then I think that this is a great option for buyers in California. So if you didn't see throughout these slides, I did have the QR code in every corner, but if you haven't already, you can scan the QR code. It'll take you to my website where you can submit an application and we can get you started on that pre-approval so that you can get your pre-approval letter for submission. And that's all I have. You can contact me at my phone number there, and that's my email address, and I'm happy to answer any other questions that you have about this program. Take care.